Welcome on board Sandeep Sabharwal as well. Find out what he's keeping on his radar this morning. Sandeep, hi, good morning. Good to have you on the show. Just so many earnings, so much news flow as well, whether it's cement, whether it's private banking earnings, and a slew of other mid caps as well. The key stock that you're looking out for?
I think results, the key, I think, development what we're seeing is in the banking side, and which is the biggest component of the market also, where I think results are showing initial signs of some stress on the balance sheets for most of the banks. And then we have the liquidity coverage ratio norms, which have been announced by RBI, which have might the final form has to yet be taken, but then that could restrict the growth of many of the banks. So I think that's the challenge which I see the banking sector facing, and I think that is something which could keep the market movements restricted.
Okay, that's banks, and that pocket seems to be stalling. But Sandeep, stay with us. In fact, I'm going to take it across to Ratan Kumar Kesh, interim MD and CEO at Bandhan Bank, and figure out what transpired for them this quarter and what's the outlook going forward. Mr. Kesh, good to have you on the show. First, let's talk about the numbers because your interest income is higher by 22%, NII uptick of 20%. What, according to you, are the levers in place to keep such kind of growth numbers coming in for the next few quarters as well?
Broadly, the levers are simple and basic in nature. Our ability to grow our advances um, quarter on quarter has been established in the last year. In quarter one, it generally is a muted quarter for us, and we generally degrow. What we have been able to establish this year, first quarter, is that we've been able to deliver a stable growth, and that's something which is important. Going forward, quarter two will be better than quarter one, and quarter three and four are definitely our best quarter in terms of advances. So that will continue. That clearly is going to happen. Our focused attempt on improving portfolio quality over the last 2 years, and very specifically April 23 onwards, some of the specific initiative that we took are holding up extremely well. And therefore, whatever disbursement we did in FY23-24, that there the slippages are extremely low, almost five-fold improvement over previous quarters. So therefore, going forward, you should continue to see that improving. Third, I think this quarter specifically, we've been able to contain our OPEX, but that's an area we will continue to make investment in people, product, technology, but we will remain watchful on that area for sure. So I think so. These are the simple levers that we are working on, and our deposit-led growth capability and our ability to grow our CASA deposits as also retail deposits remains very, very strong.
Right, morning. Now your net interest margins have been stable, but on the deposit side, there was a sharp fall in CASA. Although it is the industry trend, can you tell us what your outlook is on cost of funds and thereby how will that impact your NIMs?
Our ability to garner deposits continue to remain strong. And the fact that we have launched 500 odd branches over the last 18 months, and those branches will start delivering. So we should be able to deliver CASA growth. But yes, there is a bit of a liquidity stress in the overall market. Deposit continues to be under stress. Therefore, there could be a possibility of cost of funds stress for the overall industry as a whole, not specifically to our alone. Having said that, we are confident of maintaining 7 to 7.5 of percentages NIM as we progress going forward. We may not be able to sustain 7.6 in the coming quarters, but clearly we will be able to maintain 7 to 7.5 depending on how the overall market looks like.
Right. Let's also talk about your asset quality because fresh slippages have gone down, but gross net NPAs have increased. How is it that one should read these?
So the gross slippages, if you see for the last 5 quarters, it has come down from 1364, 1300 range to 1000 in the last quarter, and even better than that in this quarter, in quarter one, 891 crores. So that's improved. The DPT pool, if you see in the EB portfolio, it was in the range of 2,800 crores in quarter one of the last financial year. That is now down to 1,436 crore. So at one side, we are improved our slippages. The DPD pool has also come down significantly. So going forward, we should be able to maintain our credit quality, and therefore it may not be the credit cost guidance of 1.8 to 2% remains, and that's where we will try and maintain over the next few quarters.
And in the MFI segment, the collection efficiency has also gone down marginally. Although overall it seems stable, any risk building in the coming quarters?
So let me answer the region specific. Clearly in Maharashtra, Punjab, industry is seeing some stress. We also have seen a little bit of stress building up in those areas, given that the size of our portfolio is fairly small in those. In the overall landscape, we don't see significant impact of any of these. Quarter one is more cyclical, added with the heat waves and some little bit of effect of, let's say, the general election and little bit of disruption around in general. That has an impact. Going forward, if we are confident of doing that, is that our book advances will grow at a much faster pace. Therefore, in percentage terms, we don't see any challenge. Having said that, the fact that the DPT pool has inched slightly upwards in this quarter, we are clearly sort of watchful, and teams across the bank are extremely careful about ensuring that it does not add to additional stress in the portfolio going forward. So we'll remain watchful on that space.
Right. Your CD ratio has inched up a little bit this quarter, around 94%, and now the regulator has come up with those draft guidelines on LCR ratio as well, and also shown some concerns around, rising LDR for banks. What is your own internal target for CD ratio, and given the new LCR requirements, do you anticipate any impact on your loan growth?
So you are right. The CD ratio, you've been improving from almost 120% to it has come down to close to 92, 94% over the last 3 years or so. And we've been growing our deposit book at a much faster pace than the lending book. And that drive of deposit-led liability growth continues, and we will do that. That eventually means that the CD ratio will keep coming down going forward. We are targeting to take it down even further. In terms of the LCR draft guidelines, we have briefly looked at it. We have to do a lot more detailed understanding on that. But as of now, we don't see any significant impact, and we are well sort of above regulatory limits. I think we are somewhere close to the 150% LCR. So that's not necessarily a concern for us, for our bank as of now.
All right, thank you so much for taking time out. Good speaking with you on ET Now.
If you like this video, then like, share and subscribe to ET Now.